takes. As today's stress tests reveal, the core of our financial system is strong. Major banks have capital ratios 3.5 times higher than before the financial crisis. We've worked closely with the UK government, other UK authorities, and European partners to manage possible risks of disruption to the financial system. And most fundamentally, our institutional framework is robust. The bank has clear objectives, operational independence, all the necessary tools, and the resolve to deliver our monetary and financial stability remits. So, consistent with those remits, the bank is publishing 2 documents today. The first is our latest financial stability report, which details the important current risks to UK financial stability, and they run beyond Brexit. But it also includes our latest stress tests of major UK banks. And secondly, our response to the House of Commons Treasury Committee's request for analysis of how Brexit will affect the bank's ability to deliver our objectives. Specifically, the TSC requested that the bank focus on the consequences of a potential economic partnership with the EU and a no-deal, no-transition Brexit scenario. And let me begin by stressing what these analyses are and what they are not. These are scenarios, not forecasts. They illustrate what could happen, not necessarily what's most likely to happen. Building scenarios requires making assumptions about the form of the new relationship between the UK and the EU, the degree of preparedness across firms and critical infrastructure, and the response of macroeconomic policies. The scenarios are calculated for the policy-relevant timelines for the bank, that is, up to 5 years, and as such, they're not assessments of the relative long-term merits of different trading relationships. The scenarios are, however, informative about the relative economic impacts of various economic relationships and the transitions to them. Taken together, the scenarios highlight that the impact of Brexit will depend on the direction, magnitude, and speed of the effect of reduced openness on the UK economy. The direction of the effects of a reduction in openness is clear. Lower supply capacity, weaker demand, a lower exchange rate, and higher inflation. The magnitude of these economic impacts is modeled using established empirical relationships, and it's disciplined by the bank's suite of macroeconomic models to ensure their coherence and plausibility. But the speed of adjustment is less clear, given the lack of precedence of reduced openness, particularly amongst advanced economies. So the worst-case scenarios assume that adjustment to de-integration happens more rapidly than it has over the past decades to integration. This assumption is grounded by cross-checks, including econometric models, case studies, and intelligence from the bank's agents across the United Kingdom. The MPC and the FPC have reviewed the relevant scenarios, and they will use them as inputs in their policy deliberations. So let me turn to a few key observations, starting with the economic partnership. These scenarios reflect government policy and are most relevant for the MPC. They show the sensitivities to key elements of the new partnership yet to be negotiated, such as the extent of customs and regulatory checks, the degree of non-tariff barriers to services trade, and the breadth of equivalence determinations for financial services. In the 5 years under the partnership scenarios, GDP is between 1.25% and 3.75% lower than it would have been if the economy had continued growing at its May 2016 trend rate. Relative to the bank's most recent forecast in November, inflation is lower in the near term in both scenarios, given the appreciation in sterling. It rises as the transition period ends due to the fading effects of that appreciation, and in the less close partnership scenario, as custom barriers take effect from 2021. A mechanical model of monetary policy generates a gently rising path for bank rate over the scenario. This should not be taken as a prediction of the actual path for bank rates, which will depend in practice on the balance of effects of demand, supply, and the exchange rate. Turning to no deal and no transition Brexit, there are a range of possible outcomes in the event of that, consistent with the FPC's remit. a remit to protect and enhance the resilience of the UK financial system to major shocks, the FPC has focused on two variants, labeled disruptive and disorderly, which are underpinned by worst case assumptions. In both scenarios, tariffs and other trade barriers are introduced suddenly next spring. The UK recognizes EU product standards, but the EU does not reciprocate. In the more severe or disorderly scenario, the UK's border infrastructure does not cope smoothly with new customs requirements for some time. There's a pronounced increase in the return investors' demand for holding sterling assets. By the end of 2023, GDP is more than 10% lower in the disorderly scenario compared to that May 2016 trend. Despite this sharp contraction in GDP, something that's bigger than happened during the financial crisis, unemployment rises to 7.5%, less than during the financial crisis, and that reflects the supply-driven nature of the downturn. The sharp fall in sterling, alongside with the imposition of tariffs, pushes up the cost of imports, and overall CPI inflation peaks at 6.6%. In line with its remit, the MPC does what's necessary to achieve its inflation target, with bank rate rising sharply to 5.5% in the disorderly scenario, although again I'll remind you that that is a mechanical calculation. The FPC has assessed the resilience of the financial system to these worst-case outcomes, and its key findings are, first, based on comparison with the 2018 stress tests that were released today, the FPC judges that the UK banking system is strong enough to continue to serve UK households and businesses even in the event of a disorderly Brexit. So even after that unlikely event, we calculate that major UK banks will still have capital ratios around 3 times higher than they had before the financial crisis. And I'd ask you to recall that the bank stress test released today is 2.5 times more severe than the Brexit scenario, worst-case Brexit scenario I just described. That is what being prepared for all eventualities requires. Secondly, major UK banks have ample liquidity to withstand a major market disruption. They hold more than £1 trillion of high-quality liquid assets and can access an additional £300 billion of liquidity through the Bank of England's regular facilities. Major UK banks can now withstand many months without access to wholesale or foreign exchange markets. And thirdly, the FPC has worked with other authorities to ensure most risks of disruption to cross-border financial services have been addressed. And in this regard, two main actions remain. Further UK legislation, currently in train, will need to be passed for a fully and functioning legal and regulatory framework for financial services to be in place ahead of Brexit. And the European Commission needs to provide greater clarity to reduce disruption risks in derivative markets following their recent and welcome statements. Finally, the Bank of England, with other authorities, has put extensive contingency plans in place to support institutional resilience and market functioning during any period of heightened uncertainty, as we did around the 2016 referendum. We're closely monitoring market developments. We can lend in all major currencies, and if required, the FPC stands ready to cut the countercyclical capital buffer if economic stresses were to materialize. Now, the bank's ability to achieve its monetary and financial stability objectives also depends on both the transition and the end state. The level of preparedness of businesses and infrastructure such as ports, customs systems, and transportation operations will be important determinants of how well the economy adjusts to new trade barriers. Evidence from surveys and other UK authorities suggests that the country is not yet fully prepared for a cliff-edge Brexit. Surveys suggest that less than half of businesses have initiated contingency plans for no deal, and less than a fifth of small businesses have done so. Up to 250,000 traders have never completed a customs declaration. 11 of 12 major projects to replace key border systems are at risk of not being delivered by March 29, 2019. Securing an implementation period will minimize the impacts on the UK economy. And a sober, objective assessment of the appropriate length of that implementation period is desirable to get Brexit off to the right start. This implementation period should be as long as necessary to prepare properly for new trading relationships, but no longer. Turning to the end state, as you know, the UK is home to the world's leading international financial center. At around 10 times GDP by asset size, the scale of activity of the UK financial system and its complexity is unmatched in other jurisdictions. This confers a special responsibility on the bank to ensure that that system is robust to a wide range of potential domestic and global shocks. That's why, irrespective of the particular form of the UK's future relationship with the EU, and consistent with its statutory responsibility, the Bank of England will remain committed to the implementation of robust prudential standards in the UK. This will require maintaining a level of resilience that's at least as great as currently planned, which itself exceeds that required by international baseline standards. It will also require maintaining more generally the UK authorities' ability to manage UK financial stability risks. So to conclude, the Bank of England is ready for Brexit, whatever form it takes. The analysis released today confirms that the core of the UK financial system is resilient to worst-case Brexit scenarios. We have contingency plans in place to support market functioning if necessary. But to be clear, the bank being ready for Brexit is not sufficient to guarantee a particular economic outcome. There's little monetary policy can do to offset the potentially significant hits to productivity and supply that Brexit could entail. Our unwavering commitments to price and financial stability will support the necessary adjustment of that real economy. But the future potential of this economy and its implications for jobs, real wages, and wealth are not in the gift of central bankers. Rather, the economic consequences of Brexit over the longer term will depend on the nature of the UK's future trading relationship, on other government policies, and ultimately on the ingenuity and enterprise of the British people. And with that, my colleagues and I would be pleased to take your questions. Thanks.
Okay, as always, if you could please give your name and also the organisation you represent, and please stick to just one question the first time around. So I'll start with Adam and then Son.
Adam Parsons from Sky News. Governor, the bankers today presented a picture of a no-deal, disorderly Brexit that would lead to one of the biggest economic slumps in the recent history of this country. So are you part of Project Fear, or do you really think that we are looking at economic catastrophe?
No, thanks for the question, Adam. I'll be absolutely clear. Our job is not to hope for the best, but to prepare for the worst. And as I think we make clear in the report, as I hope I made clear in my opening statement, we have looked at a potential no-deal, no-transition Brexit and made a series of worst-case assumptions around that. So, for example, that port infrastructure is not ready. For example, that the EU does not recognize, there's no grandfathering of UK product standards and on. They're detailed quite extensively. And also that there's quite a sharp reaction in financial markets. The reason we do that is to be prepared for all eventualities. It's to make sure that our banks have more than enough, and at 3 times what they had even after that shock, more than 3 times than what they had going into the financial crisis. They have more than enough capital for a disorderly Brexit, to make sure that they have more than enough liquidity, and that as a whole, the way they're managing risks and the protections that they have from capital and liquidity mean they can continue to serve businesses and households across the United Kingdom. So we look at that in order to be prepared for that worst case scenario for a purpose. And the thing that I would underscore, and one of the things buried in an avalanche of paper that came out today, both the reports but also minutes that will come out, the record which will come out in 10 days from now, will unredact a series of discussions that the FPC and analyses the FPC has been doing for the last couple of years, which is exactly looking at exactly these types of scenarios and making sure that we're getting the financial system ready for something which is an unlikely scenario. And even in that unlikely scenario, we've taken it to what we think is the worst case version of that unlikely scenario to make sure that we've done our job, we've got the system ready. And what we're telling you, and if there's one thing you take from the avalanche of paper and the numbers and the discussion today, is that the core of the UK financial system is ready for Brexit, whatever form it takes.
From what comes through in your report, you say that the Bank of England is ready, the financial system is ready for Brexit, but Britain is not ready for Brexit. And there seems to be a lot in your report that's saying part of the severity of some of these outcomes is to do with the unpreparedness of business, of households, whatever, for what's ahead. Could you unpack that a little bit? How much is that to do with the severity of some of these situations?
Yeah. Well, again, I'll underscore particularly because this is all relevant to no deal, no transition, and obviously we've looked at the economic forms of economic partnership where there is a transition and there is a smooth transition. So in the case of no transition, and again with our worst case hat or visor on, as you'd expect us to be, there are several drivers of those outcomes. It starts with the frictions of the trading system because all of a sudden there are not just tariffs in place, but there are rules of origin checks, a series of customs and other checks for which the system is not yet prepared. And so that adds on top of it additional frictions. And then we have and we've laid all this out very clearly, I think. There are risk premia that come into financial markets at the same time, in part relatedly because of the scale of the economic shock and the degree of unpreparedness and uncertainty effects which hit business. To take it back to the core of your question, which is, so what's actually happening on the ground? It is our observation, and it has been for some time, that the number of business or the proportion of businesses that have contingency plans or who have initiated contingency plans or who have activated contingency plans remains a fraction of businesses as a whole. As you dig deeper into that and you have conversations with business and go at me, in several cases it is very difficult for those businesses to plan for border frictions. They can plan for tariffs, they can plan for a change in the price of selling their goods, but in terms of the logistics of making that happen is very difficult. I heard example on your program this morning, of a very sophisticated business which has that issue. That's a very common phenomena. So let's flip it around, though. The situation is that the European Union, the United Kingdom, certainly the United Kingdom government, wants a transition period to whatever form of Brexit we're taking. And certainly from what we have seen for the economy as a whole, it is advisable to have that transition period, that implementation period. And if I may, this should be a objective assessment of preparedness and the time it will take to ensure that not just for businesses, and I go back to the point that in some cases the logistical issues, you can't plan for these you can't plan around them. So it goes first and foremost to making sure that the infrastructure is there and ready to go so that we can move as seamlessly as possible to the new relationship, whatever form it takes.
Okay, Joel and then Ben in front.
Joel Hills from ITV News. All of your scenarios assume that Britain ends up leaving the European Union in some way, shape or form. What would happen to your growth forecasts if Britain ended up remaining? Well,
we weren't. We were asked by the Treasury Committee, and I'm sure we'll discuss it with them next week, to compare those scenarios that I just went through, you referenced, to, so quote unquote, the present position, okay, which is a slightly ambiguous phrase, and you could be, from our perspective, you could interpret it in two ways. The first is the present position, in other words, the current forecast that we have for the economy, which has an element of Brexit in it, obviously, because there has been an effect, as you know, Joel, on business investment because of uncertainty over Brexit. The pound is where it is because of Brexit effects as well. So you can interpret it first as that, but you could also interpret it as a scenario where we remain part of the European Union. And the cleanest, the simplest approach to that for us is to take the last forecast we had prior to the referendum, and as you'll see in the documents, there is a straight line called May 2016 trend, which is just an extrapolation of the path that the economy is on. It's nothing more, to be absolutely clear, than a mechanical extrapolation of the trend rate of growth that the economy was on, which is around 2% at that time. And then it's done throughout the document. You can compare scenarios, and I appreciate you're using the word scenarios, not forecasts, but these scenarios, whether it's no deal or partnership, relative to either the forecast we just came out with as the MPC or that previous trend, and you can make your own assessment from that.
So, Richard, just to interpret that. So
We'll if we come back to you, Joel, on the second go, if we get time for second ones. Can we go to Ben at the front and then Lucy alongside?
Ben Chu from The Independent. Governor, you mentioned this avalanche of documents mentioned several times that there's no historical precedent for a disorderly Brexit. There's nothing to guide us from the history books. Given that, what is the scientific basis for saying, as you have several times, that this is the worst case scenario that you've painted here? Doesn't it, dire as it is, doesn't that give us a sort of false sense of precision about what we're looking at here?
Yeah. Why don't I'll start and then I'll pass to Ben. Obviously, one could take the most extreme move in credit spreads, the most extreme move in uncertainty, the most extreme moves in border frictions, and add all those up. We're pretty close to that. We're not precisely at that, but we're pretty close to that in terms of what we've done. What is one of the most important things, and I just want to stress this, though, in thinking about the dynamics here, are how quickly does the economy respond to the sharp decrease in openness, and it's a sharp reduction in openness in the disorderly scenario. Not just because of tariffs and non-tariff barriers, but because of logistical problems, other factors. With that sharp reduction, we have made an assumption, and it's grounded in some case studies and some work, but we're very clear about this. This is an uncertainty. We've made an assumption that the adjustment is pulled forward. In other words, the adjustment of the economy is more rapid when you put up barriers than the adjustment of the economy than when you drop barriers in terms of a new trading agreement. And that adds a degree of difficulty, challenge. It makes it worse, the scenario worse. And so what we would suggest rather, is that we move to these fairly sharp moves, 2 standard deviation moves, for example, on uncertainty. Plus you have this dynamic that's brought in. It's justified, but we do it in order to have a worse case scenario. But Ben, do you want to?
Yeah, sorry, excuse me. We do have a lot of information, and by we I mean the community of economists, on the effect of differing trading relationships, on where volumes of trade end up and what those do to productivity. You're right that in general, in terms of the changes in those things, they've tended to go in a positive direction, certainly in developed economies, more or less continually since the Second World War. And we've not had the reverse experience. So one important assumption we make is that the magnitude of these effects is the same in reverse as it has been on the way up, as it were. I think that's a reasonable assumption to have made. What is harder to judge, and this is what the Governor was talking about both in the opening statement and just now, is the speed at which those effects come through. We think there are several good reasons to imagine that they will come through faster, certainly in the most disruptive cases. There is one case study we've used on the loss of access on the same terms to the UK by New Zealand in the mid-1970s. It's about the only concrete example we can find. We think there are independently good reasons for that, some of them related to the state of preparedness we were discussing earlier, why these effects will come through faster, certainly in the worst cases. And I would point you to the several pages beginning at page 26 in the report as to why we think that's the case. So, to reiterate, I don't think the scale of the eventual numbers is founded on as little data as you suggest. We've got quite a lot for that. The speed of the adjustment we're less sure about, but we think there are good reasons to imagine it will be slightly faster on the de-integrating side than when you have trade integration.
Okay, Lucy at the front and then Phil for the back.
Of England effectively endorsing government policy, and does that set a risky precedent, as some of your former colleagues from the Bank of England are already starting to say, that it could set a risky precedent for the independence of the central bank?
Well, let's be clear what's going on here. The Bank of England has tremendous responsibilities, has tremendous powers. It is accountable to Parliament. It's accountable to the people of the United Kingdom. It's accountable through Parliament. Parliament has demanded this analysis, right? Now, this is the type of analysis, and as I referenced earlier, we have been doing this type of analysis in order to do our jobs, in order to deliver financial stability, monetary stability, and particularly on the former, on financial stability, the type of work to think about exactly what we've just been talking about is what could go wrong, what could be really difficult, where could the financial system be caught out, and how can we get it prepared so that the financial system is part of the solution, not part of the problem. And the good news is we're here today to reinforce that, and you have, pretty substantial evidence analysis, and in the end, cold, hard capital and liquidity. And if you'd like to hear Sam Woods take up the rest of this press conference by going through the numbers, he'd more than happily do it. In terms of the assessment of a partnership arrangement, this is something that we also have to do in order to develop. And these are scenarios, not forecasts, and this gets to one of the links between the two, which is we have to have a sense of the potential implications of an arrangement that's different, after all, than the arrangement we have today with the European Union. And we have to have a sense of what UK businesses and households think about that arrangement, which isn't necessarily the same thing of what that arrangement could or will be. And obviously what financial markets think about it as well. And all of those map into, ultimately, demand, supply, and the exchange rate, and therefore the path of monetary policy. So we have to do it. And we've done it. And if you have to do it and you've done it, and Parliament demands it, and you're accountable to the people of the United Kingdom through Parliament, you expose it. And there's nothing more here than that.
Okay, just a reminder, could you mention which organisation you represent as well, please? So Phil and then James. And then...
Yeah, Phil Aldrich at the Times. In your scenario planning, the worst case scenario, you suggest that interest rates are going to rise to 5.5% as the economy crashes further than it did in the financial crisis. I just wanted to establish are we looking at theoretical extrapolations, or is this realistic that interest rates will do the complete opposite to what happened in the financial crisis? And what's your estimation of the likelihood of the worst case scenario happening?
Okay. So the first thing is In terms of the financial crisis, I think it's a very well structured question. So the complete opposite of what happened in the financial crisis. Well, in many respects, this is the opposite of what happened in the financial crisis, because as you know, Phil, the financial crisis principally, at least initially, for the first few years, was a demand shock. It was a big demand shock. And actually, when you look back over the course of our professional lifetimes and stretch further back all the way into the 70s, that is effectively what the collective we have been dealing with, which are demand shocks, gradual changes in the supply path of the economy. Some economies doing a little better on productivity, a little more on labor supply, but gradual changes to the supply side of the economy and addressing demand shocks, both positive and negative, and therefore monetary policy can be calibrated to adjust demand accordingly, bring inflation to target, or not if it's miscalibrated, obviously bring inflation to target, and support the economy that way. What's different about this is it first and foremost is a supply shock, which then has demand implications. So it is a totally different situation than people have been living with and experiencing, certainly in advanced economies, for the last 30, 40 years. We, in that situation, that's why we've stressed the supply, demand, and the exchange rate element of the framework. In that situation, we would be faced with a real challenge, and to be absolutely clear, which is we know that the direction of the hit to supply, there will be a negative shock to supply, determining exactly how much of it is coming in at what pace and how persistent that is will be difficult, and it's part of what Ben was just talking about in terms of, do we think it will come in more rapidly than historic integration? And if it is a scenario, which is unlikely, to be absolutely clear, but we've got to prepare for the unlikely one, and I'll come back to your second part. If it is a scenario where there are logistical issues and other frictions that are not frictions that are part of the new trading relationship, but are just frictions from adjusting to the new trading relationship, we'll have to make a determination about how much of the hit to supply is temporary versus persistent. And that will also have a bearing on the stance of policy. But all things equal, in a sharp supply shock, the role of monetary policy is more a sharp supply shock with an exchange rate adjustment, which is driven by future real incomes, with the inflationary effect from tariffs, which the last one we largely looked through, the first one not necessarily. It's likely to be inflationary. It'll be important, and in the end, we have a remit, which is an inflation targeting remit. We can balance that remit to a certain extent, but we're not going to ignore it. Last point, in terms of likelihood, I think when one stacks up worst case, the joint probability means that it's less likely. The possibility, but it is a possibility that we will have no deal and no transition. We have always thought that it was a possibility, a tail possibility. Maybe the probability has increased with time. You tell me, you're probably closer to it. But probabilities increased with time. But even when it was just a small probability, our job was to get the system ready to deal with that. And you can't get it ready overnight. We think the system is ready. Certainly the core of the system is ready now.
James at the front, and then we'll move on.
James Burton from the Daily Mail. Governor, if your worst case scenario came true and there was an 8% decrease in the size of the economy, would that make it the worst? Would that make 2019 the worst year for the British economy on record? And given that that is a clear possibility, what would your message be to MPs as they debate Theresa May's deal and consider the possibility of no deal?
Look, on the first, no, not the worst year on record. Certainly not the worst quarter. I think
20 when we went back on gold, certainly peak to
Yeah.
trough, the drop was almost 20%, I think. So.
Yeah, and that was the last time that the bank gave advice to the government. I think it was to go back on the gold, which answers the second part of your question, which is, no, we're not. Our job is to get the system ready for all possibilities. It's a serious job, difficult job. We have more than enough to do that. It is absolutely not our job to take one side or another on these issues. That is clearly the responsibility of parliamentarians, who will weigh many factors in their determination. We all ultimately serve the same people, which, you know, your readers, the people of the United Kingdom. Again, what we really want to get across today is there's lots of issues that people, I'm sure, are thinking about or concerned about or have questions about. The one area they shouldn't have questions about is the financial system. And the purpose of what we've released today, the part that we've released today, the no deal, no transition, the disorderly scenario, is to provide that reassurance. It's not supposed to make people scared. It's supposed to provide the reassurance that even if this happened, which is not likely, the system is more than ready for it.
Okay, if we can come along one to the front, and then Yvonne next.
Anna Isaac, Telegraph. These forecasts, which are based on given scenarios, to what extent do they reflect the advice you gave to Cabinet? I'm thinking particularly the 30% fall in house prices, the 48% fall in commercial property prices, and the unemployment rate. They seem very similar to the figures that emerged from that Cabinet meeting. And the barriers that you mentioned to financial services, were they also raised at the Cabinet meeting? And how does that inform Bank of England independence in terms of its engagement with government in that way?
First off, there's scenarios. You drop the F word in there. They're not. Okay? They're scenarios. They're scenarios with transparent assumptions, established economic relationships. Part of the purpose of the scenarios is you can see the sensitivities. If you wanted to change some of the assumptions, you can see the differences, and that's why you have sways or paths around them. Secondly, you know, look, discussions at Cabinet are confidential. And you know, that's it. That's full stop. So I'm certainly not providing a commentary on that. What the responsibility of, again, this institution is to make sure we have the system in place for whatever happens, whatever could happen, in any direction, and that's why these were developed. These were developed, I mean, of course we always refresh them, but they were developed a long time ago, right? I mean, we have been thinking about these issues for a long time. We had used, totally transparent, we had used language this time last year. Those who came here for this press conference, we talked about the stress test at the time encompassing Brexit scenarios. In other words, and you can see now transparently that our stress test, there's a chart in the executive summary throughout the document, which shows the capital drawdown in the Brexit scenario much bigger in the stress test, and then of course relative to the size of capital, it's very manageable for the banks. That's what encompassing means. So we had done this before. In different ways, we've updated it, and Parliament's demanded it, and so it's exposed. That's it.
So Yvonne and then
Yvonne Esterhazy, Wirtschaftswoche, German Business Week. Governor, you said the EU needs to provide greater clarity when it comes to clearing and I think outstanding cross-border contracts. Given that you have this joint working group with the ECB, can you tell us what's happening there? I mean, why can't you resolve these issues? And we're 4 months away from Brexit. How often does this group meet? How many people are members of this group? And why is it not? Why are things not moving satisfactory to your?
Well, I'll just say at the top level, and then I'll hand to one of the members of this group, Jean-Claude. Just say at the top level that it has been a very constructive working group grappling with the issues, analytically based, sharing experiences, and that I'll say one other thing on a high level, which is that we welcome the progress that has been made. But John, I think it's important that you go into it.
So first on the group, I think the objective of the group is to make sure that we all share the same analysis, we understand the risks, and where we can compare, if you like, the analysis and the information we have on the risks. And the group has done a lot in that area. On the specific issue of clearing, I mean, this is and clear derivatives, it's a big issue, 40 trillion by notional value of pounds of contracts in UK clearing houses will still be there after the 29th of March next year. And clearly, if the clearing houses can't depend on the European members meeting their obligations, or their boards can't know whether they're going to be able to provide those services, they would then have to take action, which in itself could be expensive and disruptive. And that's why, as the Governor has said, the statements by the Commission that have come out in the last few weeks are welcome, because they say the Commission recognises this risk, and it will grant temporary permission, conditional temporary permission, to allow the clearing houses to continue to operate with their European Union clients. I think the point that's made in the checklist, so that's recognised, but for the clearing houses, and this is first and foremost an issue for their boards, they'll need to know the timing, they'll need to know what the conditions are, they'll need to know the scope, what products are covered, so that they can have assurance that they don't need to take the action they can take. And that's what we mean when we say that greater clarity is necessary. But I think the European Commission's recognition that temporary equivalence should be granted, and the commitment to do that, is a very welcome step forward.
Okay, yeah, back here. And then Caroline in front.
Thank you. I'm Alana Petrov from Yahoo Finance UK in London. I have a question for Mark Carney. Now, you got your UK passport this month, and I'm wondering if that makes you feel more comfortable talking about the risks surrounding Brexit, as you have faced a lot of criticism for being deeply negative about Brexit. So now that you're a UK citizen, do you feel more comfortable?
Thank you, Alana. I actually don't have my passport yet. I have my citizenship, but I'm sure it's in the mail. The Home Office is a little busy at the moment. No, look, it's an interesting question. I feel as comfortable as I've ever done talking about whether it's Brexit or any other issue facing the UK economy, facing the UK financial system. Our job is to look at these issues, assess what they could mean for the financial system, for the economic outlook, if they're affecting either of our objectives, price stability or financial stability, to take the appropriate action. Look, I will say that during my time as a non-British citizen, great privilege to have this role, and I think a testament to this country and its openness that it's not about me, but somebody, to bring in somebody from outside into a role like this, and that when I travel around the country, meet businesses, meet people, I've always felt very welcome, very free to speak and represent the banks. Thank you.
Okay, just Caroline in front.
It's Caroline Binham from the Financial Times. Governor, you say with some certainty that the UK financial system could withstand the worst of all possible Brexits and banks could continue lending to the wider economy. I'm just wondering with how you can make such a sure statement, given that your stress tests are testing against a GDP fall of 4.75%. And commercial property prices falling at 40%, when under your disorderly assumptions they fall by 8% and 48% respectively. Thank you.
Yeah, so what we look at is, so it's good, it gets into the mechanics of the thing, and I don't know if Sam can pick up on this, but what we look at is the interaction between the level of rates, the level of unemployment, and the change in unemployment, the change in the underlying asset quality, asset prices, also what happens to net income margins as well, and look at that in the round. You get a sense, and I'll pass to Sam, but I'll give you the page reference. I mean, you get a sense in terms of, on page 9 of the EU document, it's also in the FSR, of the scale of losses, including the range of losses in the disorderly scenario relative to an ACS. And as I hand off to Sam, I'll just mention something else, which is in the stress test. The stress test has a lot more than a UK recession in it that hits banks. But Sam?
Yes, I think, Caroline, that really is the key chart, that chart on page 23 of the Financial Stability Report, which allows us to do a cross-check against the normal stress test we do. And I think the simplest way to express it is that in our normal stress test, the drawdown on capital for the banks is 5.4% of CET1. That's what we sometimes call the triple whammy, because you've got a UK downturn, a global downturn, and a misconduct hit all at the same time. If you come across into our Brexit shock, so the analysis of how that would play out in the disorderly scenario that Mark's been describing, you can see that the UK macro impact is pretty much the same. It comes from a slightly different set of shocks, but I think it's reassuring that it's about the same as the UK macro part of the annual test. And then we've also layered in an element of the traded stress, assuming that there was a traded stress around UK assets. So when I triangulate between those two, I feel pretty confident of the result.
Okay, Richard at the back there.
Thank you. Richard Partington from The Guardian. Governor, you've explained why you might need to raise interest rates in a no-deal scenario. However, I just wanted to ask, to what degree would the recession in 2019 be as severe if interest rates were cut to zero? Would they be not as deep as that 8% that you have estimated on your scenario there?
Yeah. I'll let Ben pick it up.
Well, I was just going to make a general point, which is that these are scenarios driven predominantly, not to say overwhelmingly, by what happens to the supply capacity of the economy. That explains the difference across all the sways, mostly. And maybe this is an overstatement, but monetary policy is essentially a sideshow. And it acts mechanically to balance any difference between demand and supply and deviations in inflation from the target, but it really is not the main actor here. It has some role because the exchange rate falls so far in the worst case scenario. Interest rates do have to go up quite steeply to contain the inflation that results. But really the fact that worst case scenario is worse is because all the other things we've been talking about that affect the supply capacity of the economy. And that is really the story throughout this report, and that explains the differences in all the scenarios.
Yeah, so said another way, and I think our colleague Michael Saunders said this the other day at Treasury Committee, lowering interest rates isn't going to open a port. Lowering interest rates is not going to allow a bank in London to continue to operate in the continent if passporting has been taken away. And it's that both of those examples are examples of reduction of the supply capacity, and the economy needs to adjust to that. Now, if demand adjusts much more than supply, then it starts to become more interesting, if you will, from a monetary, or more conventional, maybe is a better way to put it, from a monetary.
Even then, we can't get economic output above that supply capacity for very long with monetary policy.
Okay, I think that concludes today's press conference. Thank you very much for coming, everybody.